Hey guys, welcome back to Things You Should Know Accounting Edition. Today we're going to talk about the fundamental accounting equation and the basic business transaction. This equation is the basis of the rest of these lectures and represents the whole of the accounting process. This process includes analyzing, recording, and reporting business transactions. The company's assets must always equal the total of its liabilities and owner's equity. So let's give you some important terms here. If you notice, assets are properties or other items of value such as cash, vehicles, investments, or other representations of value. Liabilities are debts and or other obligations to outside creditors that are outside the company. And equity is the owner's financial stake in the company, the value of the stake. So basically, whatever's left over, that's the owner's equity. The owner's equity is not just what he's invested. So we can show this in the following equation. The basic equation is assets equals your financial interest. That's a very basic area, but a little bit better specifically, it's to say your assets will always equal your liabilities and your owner's equity. So like I said, if we go back up here, your property value, cash, vehicles, and everything will equal all your outstanding debt and liabilities plus whatever the owner's equity that's remaining. In order to give you a better idea of how this works, I'll start in some basic business transaction. Let's create a new company, and we'll call that company Jello's Coffee Shop. Jello has decided to start his own company. He wants to open a coffee shop, and he does this by withdrawing $100,000 from his bountiful savings account and adds it to the JCS bank account. Jello does this to keep his business separate from his family bank account. When a transaction even as simple as this happens, it should be analyzed to figure out how it affects the fundamental accounting equation and the books of the company. In order to analyze this, the following should be done. The process works like this. You describe the transaction. You identify the asset or property. You identify who owns the property. Is it a creditor that owns it? Do you have a loan on it? Or do you own it outright? Does it belong to you? And then you determine if it increases or decreases. What value increases and what value decreases. And remember, this must always remain equal. Your assets must always equal your liabilities plus your owner's equity. So let's check out the first transaction, that of Jello investing $100,000 into the business. The following analysis setup will break down the transaction. First, identify the assets or property. We're going to identify $100,000 invested by Jello. So we'll put it in the assets section. Identify who owns the property. Well, does it incur debt? No debt. It's not owned by anywhere else. Then we must, of course, make the value $100,000 in the owner's equity. So $100,000 asset equals $100,000 worth of owner's equity since there's no liabilities. So 1, invested cash by Jello. 2, does it incur debt? No. 3, financial equity adjustment. You just go over to the equity and increase that if it needs to be adjusted to match. So the final equation, $100,000 equals $100,000 is true, so the transaction was recorded correctly. Now we'll move on to the next transaction. Remember that while the equation says assets equals liabilities plus equity, that each portion of the equation itself can be made up of more than one thing. Let's say Jello is loath to spend the cash. He wants to keep as much of it as he can for as long as he can because he doesn't know how long it'll be before he turns a profit. So instead, he decides to buy the espresso equipment on loan. So we can start this with a $22,000 adjustment. So first, you identify the asset. That would be the espresso equipment. That'd be $22,000. So we'll start with the previous. $100,000 cash, no equipment, no loan, $100,000 equity. We're going to add $22,000 worth of equipment. So that's your purchased equipment. And then we got to figure out who owns this equipment. Well, technically, it's owned by a creditor because we still owe on a note. JCS owes Coffee RS $22,000 for equipment. We put that there. When we total everything out, we have $100,000 cash, $22,000 in equipment, $22,000 in loan, and $100,000 in equity. The final equation evens up. $122,000 worth of assets, $122,000 liabilities and homeowner's equity. Oh no! Jello completely forgot that he needs coffee supplies like beans, cups, etc. and Coffee RS is closed for the weekend. This means he's going to have to actually spend some of that cash. It's freaking him out. But he decides to spend $5,000 in supplies at a grocery store. Yes, overpriced, bad coffee, and cups. So to analyze this transaction, you'd first determine the asset. The company received $5,000 in assets in the form of supplies. 2, the company spent $5,000 for those supplies, lowering the cash asset. And 3, there's no change in equity or liability as the formula is still balanced. Let's look down here. If you look down at the calculation, we started with $100,000 in cash, $22,000 in equipment, $22,000 in loan, and $100,000 in remaining equity. We purchased supplies, so we add $5,000 to supply. So it's another type of asset we're adding in there. Like I said, assets, multiple types of things can go in there, multiple categories. And the same with liabilities and even owner's equity when you start getting into multiple owners and doing that kind of thing. In order to pay for this $5,000 in supplies, we're not going to loan. We're going to take it out of cash. So in the end, the assets balances out by itself. We take $5,000 out of cash to drop it to $95,000, but we add $5,000 in supplies. It means we do not have to make any sort of adjusting entry for the liabilities. There's no increase in loans, or for the equity, not affected. The final equation is still $122,000 worth of assets to $122,000 worth of liability and equity. Jello finally gets home, and for whatever reason, either family reasons or maybe Jello decides on his own, he just doesn't like being in debt that much. After all, you don't want to start out in debt if you can get away with it. So Jello decides to pay off $5,000 worth of the loan. Still doesn't want to spend a lot of that money, but he wants to drop it enough to appease his soul or perhaps his husband's soul. It could be either way. We will start with first, the company paid $5,000 in cash towards the debt. So we identified the asset, and it'll be cash. We identified the loan from the coffee artist as being reduced by $5,000, and we recognize that since that change happened on both sides, no other changes need to be done to the equity. So let's go down here. We started out with $95,000 in cash, $22,000 in equipment, $5,000 in supplies, and we offset that with a loan for $22,000, and the remaining equity is $100,000. We decide to subtract $5,000 off cash. That drops cash to $90,000. Then we decide that it'll of course offset the loan by $5,000, dropping that to $17,000. So when you add $90,000 plus $22,000 plus $5,000, that'll equal $117,000. On the liability and owner's equity side, you have $17,000 in liability, still owe the Coffee RS $17,000. Still not a happy family life for Jello, but you know, it's better. And $100,000 in equity means that side's at $117,000, and the equation is true and your books are balanced. So the final equation, $117,000 asset and $117,000 in equity and liabilities. Well, folks, that is how a general business transaction is handled. This is the beginning of a much larger accounting world. And if none of this was clear to you, if for some reason my teaching style was off or you just didn't catch it, don't worry. We're going to go through a lot of these over the course of the lectures. Until then, I hope you guys have some fun with accounting, and I'll talk to you next time.